Welcome to the Deep Dive, the latest installment of Talk Tickers. You've sent us your latest source material, and today we're doing a really rigorous analysis of the Q3 2025 earnings call for the specialty insurer W.R. Berkley.
Or WRB.
Yeah.
WRB.
And our mission today is pretty straightforward. We're breaking down this call to figure out, really, two big things.
Right.
First, are they truly as disciplined in their underwriting as they claim to be? And second, what is management planning to do with this massive amount of excess capital they keep generating?
And that second point is what makes this deep dive so interesting, the immediate market reaction.
Right.
The company put up phenomenal underlying numbers, but the stock reaction was, well, surprisingly muted at first.
It suggests the street had these extraordinarily high expectations that just weren't quite met.
Exactly. It forces us to look a little deeper into the nuances of their forward strategy. Okay, so let's start by setting the stage with the headline figures.
Okay, so we saw a clear beat, at least on the surface. GAAP earnings per share came in significantly above what everyone was expecting. It was $1.28, right? Beating the $1.10 consensus.
By nearly 18 cents, yeah. But and this is where that nuance you mentioned comes in.
Right. If you peel back the layers and look at the non-GAAP operating EPS.
The number that really reflects the core insurance operations.
That landed precisely in line, exactly at the $1.10 consensus.
And that difference is it's critical for you to understand. When GAAP EPS beats, but the operating EPS just meets.
It usually means that the beat was driven by something else.
Something like favorable investment gains, maybe some reserve releases, not a surprise surge in the actual business of selling policies. It signals great portfolio management, but, steady, not spectacular core performance.
Okay, so steady core performance. But despite that, the top line, the revenue, absolutely smashed expectations.
It really did. Revenue reached $3.77 billion.
Which was way ahead of the, $3.15 billion consensus?
Yeah, representing a really robust 10.8% year-over-year growth. And crucially, as you pointed out, they do this while maintaining exceptional quality.
Exactly.
The underwriting engine remains the hallmark of this company. They posted a calendar year combined ratio of 90.9%.
And just for anyone who might not track insurance day to day, that combined ratio, it's a measure of expenses and claims paid out versus the premiums they brought in.
Right. Anything below 100% means they're making a profit just from underwriting. And 90.9% is excellent.
It's especially impressive because that 90.9% includes $78.5 million in catastrophe losses for the quarter.
Mm-hmm.
If you look at the current accident year combined ratio and you exclude those the sun, it stands at an even more robust 88.4%.
Which just shows the underlying structural profitability is incredibly strong.
Okay.
So we've established the underwriting engine is highly profitable. But the second engine investing was also a massive and compounding driver this quarter.
Right.
We saw net investment income climb to $351.2 million, which was fueled by a 9.4% increase in the core investment portfolio year over year.
What's fascinating here is how the management frames this. They call it a two-engine story.
A classic two-engine story.
Exceptional underwriting profitability paired with a rapidly compounding investment book. They're executing on both fronts, but the key is the discipline behind the underwriting.
That discipline is the entire foundation of the call. We noticed that net premiums written only grew 5.5% overall.
Even though the average rate increases they were getting, if you exclude workers' comp, were much higher.
Significantly higher at 7.6%. This really highlights the tension. Growth versus discipline.
It's textbook discipline, yeah, but isn't that calculated decision maybe why the initial market reaction was so muted?
Could be.
Are investors implicitly punishing them for choosing discipline, for walking away from business where rates weren't high enough over just maximizing immediate top-line growth?
That's the core tension they are navigating, and management is completely unapologetic about it. They are choosing rate adequacy over volume, full stop.
And this connects directly to the CEO's commentary right at the top of the call.
It does. He highlighted that the insurance industry is still inherently cyclical and prone to what he called self-sabotage.
That's a cynical view, but probably a realistic one for the industry. Can we define what that self-sabotage actually looks like in practice?
Sure. It looks like competitors compromising their actuarial standards. Meaning they're reducing rates or broadening coverage just to grab market share when capital is flowing freely.
I see.
WRB mitigates this tendency with its differentiated focus on, niche and specialty markets, smaller accounts, where pricing power is just easier to maintain.
That strategy is their competitive moat.
Yeah.
Management explicitly said, Larger equals more competition, smaller equals less competition.
which heavily favors their decentralized specialty platform model.
So let's see how that discipline played out across the specific business segments.
Okay. The view on liability lines remains complex. Commercial auto, for example, was described as choppy.
We hear that term social inflation constantly now. For our listeners, what does that practically mean for an insurer like WRB writing these commercial auto policies?
It means rising litigation costs, it means bigger jury awards, and just a general trend of juries siding with plaintiffs. It leads to larger and more unpredictable loss payments.
So it's a huge risk.
A huge unpredictable risk. And because of that, management stated they are proactively reducing their exposure in commercial auto.
Which is why the top-line growth in that segment was so much less than the rate increases they were getting.
Exactly. They're actively shrinking their risk appetite there.
And we saw similar complexity in professional liability, right?
D&O erosion is thankfully slowing down, but E&O remains a mixed bag. They did specifically call out hospital professional liability, HPL, as a brighter spot within that whole segment.
Okay.
Overall, they noted they are actively pivoting the entire portfolio. And that's driven by these legal environment trends and adjustments to their appetite regarding attachment points and jurisdiction.
That's important technical language. Let's unpack attachment points. What does it mean when they're adjusting their appetite for those?
It generally means they're changing where the risk attaches to their balance sheet. So instead of covering the first $1 million of a loss, which is a lower attachment point,
Right.
they might now choose to cover the $5 million to $10 million layer, a higher attachment point.
So they're taking less of that first dollar risk and moving up the risk tower.
Precisely. It makes their exposure more remote, but also potentially more volatile. It's a move designed to mitigate the effects of that social inflation we just talked about.
Got it. Okay. Turning to the property and reinsurance segments, management seemed to offer a clearer view of where pricing power is starting to soften.
Yeah, in property, competition is heating up the most in what they call layered and shared limits.
Which refers to those massive, complex commercial policies that are too big for any one insurer to handle.
Right. So several insurers divide up the risk in layers. They are finding better opportunities in the small admitted space and select homeowners markets, smaller, more localized risks where they can maintain that discipline.
And in reinsurance, the commentary was, well, pretty colorful.
It was. Management signaled the bloom is off the rose in property catastrophe reinsurance.
They expect further erosion and increased appetite at the crucial January 1st renewal cycle.
Their quote, they said they were getting their last bites at the apple before the apple starts to rot. That tells you everything you need to know about their cautious outlook on that specific market.
Wow. Okay, this brings us directly to the investor context then. Because regardless of where they are finding or avoiding risk, the company is generating capital at an astounding pace.
It really is. They hit a record common stockholders' equity of $9.8 billion this quarter.
That's a major financial buffer. How does management even plan to manage a buffer that large?
Well, they confirmed that by the rating agency models, the company has significant headroom to the tune of 10 digits.
And when you hear 10 digits in a corporate context, you're talking about billions in excess capital.
Billions. Cash that is essentially just idling on the balance sheet.
And their philosophy on capital allocation is pretty simple. Capital belongs to shareholders if it can't be utilized effectively in the business.
Yep. And given that the nearest debt maturity isn't until 2037, there's no immediate pressure to pay down debt. So the focus remains squarely on special dividends and opportunistic share repurchases.
But they were very clear that they're not impatient.
Not at all. They're waiting for the right opportunity to aggressively buy back stock. They're prioritizing shareholder return, but they want to maximize the effect of that return. They won't just buy back shares because they have the cash.
They'll wait for a good price?
They wait for a good price.
Beyond the capital structure, the second major structural tailwind that's driving future earnings is that investment engine.
The spread between new money rates and their existing book yield is highly favorable.
And we can quantify that tailwind perfectly.
We can. New money rates for domestic bonds are around 5.0%.
Okay.
Which is comfortably above both the fixed maturity book yield of 4.8% and the domestic book yield of 4.6%.
So that persistent gap basically ensures that as their massive bond portfolio constantly turns over, investment income is just going to continue to climb structurally.
For the next few quarters, yeah. And they are locking in that future income by nudging the duration of the fixed maturity portfolio out slightly to 2.9 years.
Which reflects management's confidence that this runway exists for continued book yield improvement.
And it's all supported by nearly $2.6 billion in operating cash flow year to date. They absolutely have the cash flow to sustain this strategy.
And finally, we should just note why management is avoiding giving any hard EPS guidance.
Right. They cite that major parts of the marketplace, commercial, auto, property, are in a period of flux.
It makes it difficult to predict the near-term growth opportunity.
Which they suggested could range anywhere from 4% to 10% next quarter. They simply won't compromise rate integrity for top-line growth, even if that means giving a fluid growth outlook.
That strategic flexibility is a massive asset in a choppy environment. Now let's pivot into the segment everybody waits for, where we throw out a plausible but aggressive trade idea based entirely on the structural themes we've just discussed.
Okay, but before we proceed, a quick word from our legal team.
Of course.
This segment is strictly for entertainment and provocative thought. We are synthesizing public information to craft an intellectual exercise. This is not investment advice, trading advice, or a recommendation to buy or sell any security.
Understood. Any investment decision should be made with a registered professional.
Exactly.
Okay. With that out of the way, the core structural theme emerging from this deep dive is crystal clear.
It is.
Massive excess capital combined with management's opportunistic, non-impatient stance on returning it. That capital is a time bomb.
Right. So the plausible trade idea here leverages that inevitable capital event. You go long WRB.
But not based on the incremental quarter-to-quarter underwriting results.
No. You go long based on the future expectation of a massive, non-cyclical special dividend, which management prefers, or an unexpected, aggressive share repurchase.
The executive chairman stated it explicitly. They're waiting for the right opportunistic entry point to deploy that capital.
Think of a dip fueled by macro anxiety, or, maybe a sudden market correction.
That's the moment they will seize to maximize shareholder value with a huge buyback.
So the pitch is simple. This stock is a high-quality insurer that generates cash faster than it can deploy. It is holding acknowledged 10-digit capital that must eventually be returned.
Therefore, the real trade isn't in waiting for Q4 operational results.
No, it's waiting for the capital signal. The current stock price, trading muted after the earnings beat, is essentially discounting the next year's operational results, but not a significant one-off capital event.
So you're holding this position as an asymmetric bet on management's discipline and the inevitable return of all that excess capital. That's our provocative pitch for today.
It's a compelling argument. It reframes the stock from an operating company to a sort of capital distribution mechanism.
Okay, to quickly recap the main takeaways from this deep dive. WRB delivered excellent underwriting ratios with a 90.9% combined ratio.
Supported by powerful investment income growth.
And underpinned by a deeply capitalized balance sheet containing billions in acknowledged excess capital.
And here's the final thought we want to leave you with. It's one that builds on their disciplined approach and this capital fortress they've built.
Okay.
Management highlighted that while WRB's internal growth drivers, like Berkley One and their A&H business, are strong, they are specifically not leaning into high cat exposure states.
Right.
So the question for the long term is this. Given the capital fortress they built, is the market potentially underestimating WRB's ability to act as a counter-cyclical acquirer when softer markets and the aggressive softening in the reinsurance segment force competitors into distress?
That is the ultimate strategic option that all that excess capital affords them. Thank you for tuning in to this deep dive. We'll be back soon with more insights.